on TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're lucky to be joined again by Jack Trengove from Lanyon Asset Management. Jack, thanks very much for coming back on the show.
Thanks for having me, Chris.
Now, me and Teddy Richards were competing for Football Finance Guide post-footy for a while with some small podcasts, and you just came straight out and blasted us out of the water with a genuine funds management career. So tell us what the transition's been like and how Lanyon Asset Management's investing.
Yeah, no, it's been a smooth enough transition. I'm certainly sneaking under the radar compared to you guys, but yeah, I joined Lanyon over 4.5 years ago, so we're a long-only equity fund manager, value-oriented, high conviction, 15 to 25 stocks, and I'm really enjoying it. There's a lot of similarities between sort of professional sport and this industry, as you know, and I'm learning a lot and loving every second of it.
And pretty broad mandate. I understand you're focused more on domestic equities but are allowed to invest overseas as well, is that correct?
Yeah, I think a big part of our process was trying to take away any of those institutional constraints which really cripple the industry these days, and our bread and butter are small to mid-cap Aussie companies, but at the same time we have the ability to invest globally when the right opportunity pops up. So yeah, very broad mandate.
And what stock did you want to talk about today?
The stock I'm going to talk about today is Fraport. So Fraport, a global name, actually owns and operates the Frankfurt airport along with a number of other smaller regional tourist airports around the world as well.
And whereabouts are they listed?
So that's listed in Germany, and that's where the origins of it is from, and the principal asset is the Frankfurt airport. It's about a €4.5 billion market cap, and we think it's presenting as a really, really fascinating opportunity at the moment.
And outside of Frankfurt, talk us through the other airports that they own or have stakes in.
Yeah, so they've got stakes in various other assets, as I said, more tourism regional type assets, so countries like Greece, Bulgaria, Slovenia, Peru, Brazil, Turkey. There's about 30 different airports within their portfolio, but the bulk of their earnings comes from Frankfurt.
And are there some of those airports that stand out as really strong performers and have bounced back post-COVID, and some that are still struggling? What does the mix look like?
Yeah, so as we know, COVID-19 hit back in 2020, and it absolutely decimated the travel industry, and Fraport and their assets, or their portfolio of assets, were certainly hit and impacted by that. Most of the tourism regional airports have responded and recovered back to pre-COVID levels, and it's been really encouraging. I think we all know that a lot of people are back on planes and travelling like they were previously, but in the peak hysteria of it all, people never thought the travel industry would recover. However, Frankfurt Airport is still behind those 2019 levels, but we think they're on a really good road to recovery over the next couple of years.
And in terms of the business model, can you break down how much of the revenue comes from aeronautical revenue, how much comes from, parking, retail, fees from car hire agencies? What does that sort of split look like?
Yeah, so I guess from the whole company's perspective, if you think about it as 50-50 split between the international portfolio and Frankfurt itself, and then within Frankfurt, it's more or less about 40-40-20 when it comes to aviation charges. That's a big part of their revenue or their earnings part of the business, because they charge an aviation charge to every airline carrier that comes through the airport. But then they also get the retail and real estate earnings from the terminals themselves and the different businesses within that. So it's a really nice split between those different parts of the business to make sure it's diversified.
And what are the top-down things that you see that really move the market for this type of investment? Is it just travel numbers? When you see the oil price tick up, does that make you nervous? What are those sort of macro factors that you're looking out for to affect an investment like this?
Yeah, I think it's some really interesting statistics that have come out from doing a lot more research. So the Frankfurt airport itself is the 16th busiest airport globally, the 6th busiest in Europe, and then it's home of Lufthansa Group, which is the 4th largest airline carrier by revenue in the world as well. And like any industry, airports and travel is certainly impacted by, cost of living pressures and things like that. But between the years of 2000 and 2019, passenger volumes grew at 2% over that period, and we went through various different economic cycles through that. So it gives us real confidence as to where, passenger volumes are heading in the future. The other lever that the airport has in terms of generating higher earnings is those aviation charges. So Frankfurt Airport put through a 9.5% increase in aviation charges this year, and they're going to do another mid to high single digit increase next year. So that gives us confidence again of where earnings is going over the next 3 to 5 years.
You mentioned Frankfurt's not quite back to 2019 revenue levels, but some of the other ones are, and some of them are well surpassed. Does it speak to that tourist traffic being really strong at the minute, and perhaps some of the business traffic yet to get back to pre-COVID levels?
Definitely. I think you've hit the nail on the head there. I think tourism really strong again. Everyone's back. We're about to hit European summer now, and all of our friends and family are heading over to Europe to go travelling again. So the tourism element is certainly back. The business travel, it's changed a little bit since COVID. Obviously, we can do things via Zoom and on Microsoft Teams these days. So, there's a lot of cost savings from a corporate level. So that potentially is not going to get back to where it was in the past, but we still think that's going to continue to recover over the next couple of years. And we think that, Frankfurt Airport will get back to not only what volumes were pre-COVID, but continue to go at that 2% rate over the next 5 years.
And airports can be CapEx hungry. What does their CapEx profile look like over the next, call it, 3 to 5 years? Yeah,
so that's probably why this has been, gone unnoticed, this company, for a lot of investors, and particularly a lot of large infrastructure institutional investors who historically put all their capital in these sorts of assets. CapEx has been a big issue with this company. So they're building a new terminal. So back in 2009, the German government, along with Fraport themselves, decided and agreed upon building a new terminal at the Frankfurt Airport, which at the time they thought passenger volumes were going to swell into the 2020s to 90 million, which would put them in top 3 busiest airport in the world. But through that period, obviously COVID came, and the other thing that people are scared about was obviously the balance sheet stress that's coming from investing such a large amount. So this third terminal is going to cost them about €4 billion. So they're essentially investing their market cap into this terminal, which stretches the balance sheet and makes people very worried from an investment point of view. But that is going to be constructed and completed by the end of next year, and we think that a lot of that risk is behind them now, which is why it's presenting as such a good opportunity for us today.
And do you see them needing to raise any additional equity for that, or do you think the debt funding will be enough to get them through that CapEx cycle?
They definitely don't need to raise capital, which was one of the biggest risks that we look at, and they're well and truly got a strong balance sheet to support them through this CapEx. And then once they start generating a lot of more free cash over the coming years, once that's completed, then we think they're going to be able to really de-lever that balance sheet. And the board are even going to reinstate a dividend in 2026. So both really strong catalysts for the share price going forward.
And Lanyon are renowned for being long-term value investors. When you look out to 2030, what are sort of forecasts you put on a business like this that make it attractive to invest in today?
Yeah, so the other interesting part about this investment opportunities, management have forecasts out there, or targets, so to speak, for 2030. So the business is going to generate about €1.3 billion EBITDA this year, and by 2030 they think that's going to be €2 billion of EBITDA and another $1 billion of free cash flow. So we think on a pretty conservative multiple. You think about recent transactions, Sydney Airport, different assets, but that transacted at 27 times EBITDA.
And didn't drop a bucket load post-COVID, did it? It never looked cheap even. People still wanted to buy it.
Exactly. And then even Auckland Airport, listed here on the ASX, that trades at over 20 times EBITDA.
Yeah.
So on our conservative numbers, we've applied a 10 times multiple on that earnings profile out to 2030. And if you do that, that gets you to a value of €20 billion. Take away the net debt of about €7 billion expected at that time, and it gets us to an equity value of €13 billion, and you're sitting today at $4.5 billion. So that's potentially a nearly tripling of the share price between now and 2030. And at Lanyon, we focus a lot of our attention on what an earnings profile is in 3 to 5 years' time and try not to get caught up in the short-term noise. So we think we're going to be able to generate a really strong return for our clients on this investment, given the fact that on some pretty conservative assumptions, there's a lot of upside there.
And rates starting to come down in Europe, and that helps most businesses, but particularly a business like this, that's a potential catalyst for a re-rate as well?
Definitely, yeah. I think when you've got a pretty stretched balance sheet as it is now, cost of debt hasn't been cheap more recently, but if rate cuts do start coming, that's going to be beneficial for a big infrastructure asset like this. But you know, that's not the base case for our investment in this instance, but that would certainly help and be another catalyst.
Any other catalysts we should keep an eye out for? It's really just a valuation play and need to get through this current refurb and enjoy the free cash flow that comes.
I think that's it. Like, I've explained most of the catalysts here, but I think now it comes down to execution and passenger volumes to really start returning back. So they're expecting 63 million passengers this year, and we think by 2030 that's going to swell to 77 million. And you get that coupled with the idea of delevering their balance sheet, and I think a lot of investors that are sitting on the sidelines waiting at the moment will start to get excited, and there'll be a lot of demand for this company over the next couple of years. But we're sitting in a really privileged position right now where we can invest when it's at a large discount to our assessment of value, and we think that that's really going to be realised over the next 2 to 3 years.
Brilliant. Well, brilliantly presented. Thanks very much for taking the time and coming back on. Good to catch up.
Beautiful. Thanks for that, Chris.
Thanks, Jack. You've been watching Talkie Book. We'll be back here for the same time next week. Thanks for...
You're watching Ticker. We'll have more in just a few minutes.